Hey guys, welcome back to Envisage Academia. Today we're going to be doing economics under the topic of national account aggregates and conversations. Now, one may ask, what exactly do we mean when we talk about national aggregates? Now, the national aggregates, these help analyze the economy. They help measure and analyze exactly where the economic growth of a country is heading at a certain period of time. Now, let us look at the real definition of these national aggregates. Now, these are the significant measures of the result of economic activity, right? They help make analysis of the economy, and they are useful in measuring and comparing economic growth. Right. Now, the national aggregates, there are three ways in which they can be identified, which is in the form of production, in the form of expenditure, and income. Now, let us look at the main keyword of the day before going into broader detail of the national account aggregates. Now, our keyword is the gross domestic product, right? When we talk of the gross domestic product, which is GDP, we talk of the monetary value of all the final goods and services produced within the boundaries of a country over a specific period of time. Now, when we talk of the within the boundaries of the country, meaning that GDP only focuses on what is produced only in the country and not out of the country. Monetary value of all the final, which means our GDP focuses only on the final goods, goods which are ready for consumption, and which then excludes goods that are not ready or goods that are used to produce other goods, which are also known as capital goods. These are excluded in the calculation of GDP. Also, the intermediate goods, they are excluded in the calculation of GDP. Now, let us look at the different ways in which we can identify the aggregate national accounts. Now, identification of the national accounts. We speak firstly about production. Now, when we speak of production, this focuses mainly, which is the sum of all production units produced by the primary, the secondary, and the tertiary sectors in an economy. The second one, we have expenditure. Expenditure then, we look at the total expenditure on final goods and services produced within the boundaries of the country, right? Remember, in production, we focus mainly on only production of units by that which are produced, only the production of units which are produced by the sectors of the economy. And on the expenditure method, we focus on the spending on final goods and services which are produced within the boundaries of the country. Now, on the income method looks at the sum of all the income which is earned by resident individuals or firms in the production of goods and services. Now, let us look at this in broader detail. Right, production. This is GDP, which is gross domestic product. P, which stands for production, right? Now, it sums up all the production in the primary, secondary, and the tertiary sector, right? This is the production method. Now, how do we calculate this? It is calculated by taking the gross value added of total output and lessing the value of the input utilized in the production process, right? Now we calculate it by taking all our output, which is related to what we produced, and we less all the input that we used in the production process, right? Let us go to our second method, which is the expenditure method, right? Expenditure on the GDP is the total expenditure on final goods and services produced within the boundaries of the country. And it is calculated by adding all the expenditure of the four participants in the economy, right? Using the expenditure method, we calculate the spending of all our participants in the economy. We talk our participants, we talk of households. We add the sum of all the spending of households, we add the sum of all the spending of our businesses, we also add our government, which is the public sector, and we also include the foreign sector. We look at all those participants in the economy, and we add up each and every spend. Now, let us go to, now, if you look at this circular flow model, it shows some of our participants in the circular flow. We speak of the businesses and the households. However, our firms are not included and our foreign sector is not there, but they are included under the expenditure method. Now, we also look at an example of spending by the government, right? This photo here shows how the government plans its spending in the country, which shows the different amounts. Now, this is a great example of how expenditure takes place. Now, with this method, we're going to take all this spending of our participants, sum it up using the expenditure method. Now, let us go to our income method. On our income method, right? On our income method, this is also known as the gross domestic income, right? Now, the gross domestic income is the sum of income earned by resident individuals or the firms in the production of goods and services, right? Now, you must note that now the total income earned must be equal to the value of production. Why? Because now every factor of production earns income when goods and services are produced. Right. Now, going forward, we're going to look at our national account conversations. Now, we've got 4 sets of prices which are used in the national accounts. Now, here we speak of our basic prices, we speak of our factor cost, our market prices, and our net or gross figures. Now, when we speak of basic prices, the basic prices, these are the initial prices in the production of final goods and services, right? The initial prices now, before we consider any taxes or any subsidies, we speak of basic prices. It is where now our taxes and all these subsidies are not yet taken into consideration. Now, let us look at our factor cost. What are factor costs? Factor costs are used when calculating using the income method, which we will discuss in more detail, right? Are you calculated using the income method and the factor price? Our factor price, it is mostly like represents the price received by each factor of production, right? It could be rent, we speak of wages and the salaries, interest and profits. Right now, on our factor prices, they actually represent those remunerations that are earned by the factors of production. Now, let us speak of the market prices. The market prices are used when GDP is calculated using the expenditure method, right? These are the prices that consumers pay for goods and services, the prices that we pay in the shops when we buy goods, when we buy services, right? And these prices, they include taxes, they also include subsidies, right? We speak of market prices. Now, let us look at our net gross figures, right? The net figures are used in national accounts. They have already had an amount of funds subtracted from them, right? It means now a net amount, it represents the total amount after the provision for depreciation has already been deducted. Now, let us go and now into detail about this. Now, as we said, the basic prices, right? Our basic prices, these are the initial prices in the production of final goods and services before considering our taxes and subsidies. Right. Now, our factor costs, they are used when gross domestic product is calculated using the income method, right? And it represents all remuneration that is earned by the factors of production. Now, let us discuss this in more detail. Factor cost. They're used when GDP is calculated using the income method, right? Now, do we still remember what is that income method? Let us go back, right? In the income method, how do we determine this? What happens? In the income method, we take the sum of all income and by our households, right? This here is now related to our factor cost. It means now we use the factor cost when determining the sum of all revenue that is earned by our factors of production, right? Now, it represents all remuneration that is earned by factors of production, right? What are those factors of production? Remember, our factors of production, these are the inputs available to the supply of goods and services in an economy, right? They include land, they include labor, they include capital and entrepreneurship. Now, the remuneration, this is what now the factor costs are more focused in. We are more focused on the remuneration of land, which now we speak of rent. We are more focused on the remuneration of labor, when we talk of our wages and the salaries. We are focused on the remuneration for capital, where we speak of the interest, entrepreneurship, also where we earn profits. Now, this is now an interrelationship between our factor cost and our income method. Right. Now, let us go to the market prices. As we said, the market prices, they are used when GDP is calculated using the expenditure method. Now, how do we calculate this expenditure method? Now we go back to our expenditure method. What happens? At this, it's calculated by adding our certain specific spending on all of the 4 participants of the economy. Now we use the market prices when adding the spending of all the 4 participants in an economy, where we make use of our market prices, right? Now, these are prices that consumers pay for the goods and services, and they include taxes and subsidies, right? Right. Remember, on our basic prices, we don't consider taxes and subsidies. However, when we calculate using the expenditure method, we consider our taxes and our subsidies, meaning that we are making use of our market prices. Now, one may ask, what are taxes? When you speak of taxes, these are just compulsory contributions to state revenue on workers' income, on business profits, and they are charged on some goods and services, right? Ones which are charged on goods, we speak of value-added tax, one which we pay for when we purchase certain goods and services. That is an example of a tax. What are subsidies? Subsidies, it's just money which is granted by the state or a public body to help an industrial business keep price of a commodity or service low, right? Let us continue and talk of our net or gross figures. What exactly do we mean when we speak of the net or our gross figures? Right. The net figures, they reflect the amount after provision of depreciation has been deducted. Now, it means now on our gross figures now, there is a certain amount that has already been deducted, of which now we speak of depreciation, right? They help give information about the permanent resident of the country. It could be those which are in the country or are not in the country, as long as they are permanent residents of the country. How do we calculate our gross national income at market prices, right? Now, our gross national income at market prices, also known as GNI. We calculate it by taking our gross domestic products and market prices. We add the primary income from the rest of the world and minus primary income to the rest of the world. Now, let us outline some of the keywords that might be a bit disturbing. Now, we speak of domestic figures. The domestic figures, these are all the economic activities that occur within the boundaries of a country. Each and every transaction that takes place within the country, we speak of the domestic figures. Now, gross domestic product, it can be expressed in two ways, where we talk of nominal figures and we talk of real figures. When we speak of our nominal figures here, we look at when we are taking into consideration, we're not taking into consideration the changes into or changes of price level into account. That is where now we have nominal figures. And when you talk of real figures, it is where now the changes in prices have been taken into consideration. Please don't forget to subscribe and share with your friends. Thank you.